Our next guest says he has been wrong about a year-end rally, but this bull market is not dead. Let's welcome back Joe Zidle, Blackstone's investment strategist. Joe, great to have you with us. I think a lot of people had a call for a year-end rally, so you're in good company at this point.
A lot of people have been wrong on that.
Why are you sticking by the bull at this point, especially when we're seeing sort of a rolling bear market unfold in this market where you have various sectors roll into the down 20%?
Yeah, the conditions that end bull markets are just not in place. You know, if you think about what ends a bull market, it's an inverted yield curve, right? Or it's negative earnings growth, or it's negative GDP. And if you look at the conditions for 2019, I think what people are confusing or conflating is that we might have seen peak earnings growth, but it doesn't mean that growth is actually rolling over. I think EPS growth is going to be higher in 2019 than it was in 2018. Now, granted, we're not growing at 20% or 10% year-over-year EPS, but we still have positive growth rates. And what that means for stocks, I think, is that this sell-off is overdone. I think this is a sentiment issue, not a fundamental issue that we're seeing here.
So let's look ahead to 2019. I mean, 2018 is pretty much in the rearview mirror. So what are you seeing in terms of what kind of returns you're expecting?
Well, I think they're going to be positive. We don't have our 2019 price target out yet. We're going to be publishing that on January 3rd. But generally, the way I look at the fundamentals, it argues that, number one, we're going to see earnings growth. It's going to be slower, but we're going to see it. Number two, we're not headed toward a recession in any major economy out there. Europe worries me a lot. I think there are issues going on in Europe, specifically with Italy. Obviously, Brexit is a disaster for the UK economy, and it'll have ramifications for Europe. But generally speaking, what we knew back in September, think about September 21st when the market hit 2940 on the S&P. What we knew then was that, number one, trade war, number two, Brexit, number three, slowing earnings growth, and number four, slowing year-over-year GDP growth. What do we know today? We know all those same issues. What's different? Back then in September, the 10-year Treasury yield was sitting at about 3.25%. Today, it's about 2.88. Right? That's actually better for equity valuation, because if you think about how to value companies, it's earnings and interest rates. Both of those are actually tailwinds for equities. I think investors are just massively overreacting right now.
But Joe, you named a couple things that are really important. I mean, can you explain to our viewers, though, that it wouldn't take so much to have the yield curve invert, right? To have earnings year over year get to flat, to basically negative, right? Sure. Negative growth. I mean, these are not things that are now something that, we have to think out that could take 18 to 24 months to happen. Isn't that correct? Could they happen pretty quickly if we had a global slowdown and some sort of event?
Sure, I think you're absolutely right. These things could happen anytime. But I think what people misunderstand about a yield curve is that it can stay flat for a long time. In 1995, the yield curve flattened and stayed flat for the next 4 years. It averaged 36 basis points over those 4 years. Yet economic growth ripped. The economy grew at 3.8% a year over those 4 years, and the markets took off. So a flat yield curve is not really a warning sign of anything. The data tells you that markets and economies can do well in a flat yield curve. So I don't think it's a flat yield curve means it's automatically going to invert. Now it could, and once it inverts, we know two things. Number one, the bull market will be over, and number two, we'll have a recession in 12 to 18 months. But I don't think that yield curve is going to invert anytime soon. And then secondly, on negative earnings or negative earnings growth, it happens. And I think what people confuse is that a business cycle works at a different speed than an economic cycle. And a business cycle, corporate profits, your trough in earnings to a peak in earnings, the average time on that's about 7 quarters, whereas an economic cycle is many, many years. So you get greater ups and downs. So 2015, in the third and fourth quarters of 2015 and first quarter of 2016, we saw negative earnings growth, and that was a bad environment for equities. But I don't think we automatically tip over into negative earnings growth anytime in the next few quarters.
Joe, thank you. Joe Zidle, Blackstone. Ray of sunshine on this desk.
Well, good for Joe for coming in here. First of all, great to have Blackstone on the desk. Great to also hear a view that's at least getting back to a view that he said, a couple months ago, people couldn't find enough positive things to say. Again, I'll remind that I think credit markets had not fallen apart. What bothers me since September is that credit markets in mid-October did fall apart. We are getting a dynamic where I think that's also going to feed into the optimism. But, you started to see, again, this NAHB housing index today. The last 2 months, the cumulative effect of 2 months is the biggest move we've seen in this index in many, many years, and that concerns me.
Yeah. Again, the reasons for us slow are far more than the Fed. I think the silver lining in this is we could get some news out of the Fed that gives us a couple-week rally that will surprise a lot of people, I think. With that said, Europe is absolutely a mess. You're talking about $5.3 trillion balance sheet over there. You're talking about a lot of negative rates across the continent, which is disturbing. I mean, there's just a lot of headwinds. Bring that, and what Dan talks about as well, we don't even talk about the potential for political risk here in the form of a Mueller investigation. That's not a political commentary. That's out there. And with every passing day, I think that grows more viable.